Okay, so today, guys, what we're going to be talking about is we're going to be extending that idea that we were introduced to in the week before the test, this idea of Forex, right? And now we're going to be adding an additional layer because we're going to be talking about hedging accounting or hedge accounting at least. So you guys will remember in the first part of our lecture, we did some definitions. We spoke about different types of rates. We spoke about different events that happen when we have a transaction, like transaction date and year-end date and settlement date, etc. And so we defined those important concepts in our background. Then we went on to talk about unhedged items, right? Unhedged items, which is what we did in the week before the test, and we looked at three specific unhedged items. We looked at creditors, right? So we looked at what happens if we've got a foreign creditor and it's unhedged, and then we looked at loans, right? So what happens if we go and get a loan from a foreign bank, right? And then finally, on that Friday, we added that idea of debtors, right? And we said what happens with an unhedged debtor. So we did creditors, loans, and then debtors, right? So we looked at three broad topics, and basically debtors is just a reverse of creditors. So it wasn't really too complicated. Then we spoke a little bit about financial statements of foreign entities and how we need to translate them, and stuff on the income statement is done on the average rate, where stuff on the balance sheet a statement of financial position is actually done at the closing rate, and then any differences between those two rates, because remember those two statements need to talk to each other. Any differences between those two rates go to something called foreign exchange reserve. So that's what we spoke about there in number 4. And then finally, we did disclosure, and we looked at the three different types of monetary items that we looked at. So we did creditors disclosure, loan disclosure, and we did a little bit of debtors disclosure. Um, so today we're trying to develop that topic, and we want to try and look at hedged foreign exchange transactions. So what does this word hedged foreign exchange transactions mean? Um, well, you guys would accept and you guys would understand that when we talk about a hedge, what we're actually talking about is a type of fence. So if you look at the picture on the side of your screen, you're going to see like a grass structure, right? That grows. It's not a grass structure. It's like a bush, and it's a shrub, and it's grown to a specific height, and then it's trimmed into a hedge, right? And what that does is it offers protection, right? So it offers some sort of protection, you see. And so hedge accounting is the act of trying to protect against foreign exchange risks, right? And just, sorry guys, while we're just there, I just want to mention something. Um, with regard to your class notes, um, specifically on this section, we've prepared the class notes in such a way that you guys can rely on the class notes to get you through the topic. So chapter 12, which is what we did the week before the test, um, does touch a little bit on hedge accounting. But if you guys really want to get the full picture, I would suggest that you go to the class notes. And there is a section on IFRS 9 in your textbook, but you can and you should read through it. But also just look at the class notes, and you guys will get a good picture. We've got examples in the class notes as well as our class examples that we do here. And obviously your workbook has some notes on what exactly hedge accounting is. So those are your sources. Back to hedging. So hedge accounting is the act of trying to protect against foreign exchange risks, right? So we're looking now at that foreign exchange loss. And you guys would remember the week before the test, we used to have foreign exchange either loss or gain, right? And so it can often swing between loss and gain and loss and gain from one period to the next. So when we do hedge accounting, we're trying to prevent or limit those swings between losses and gains. And so what we're doing is we decreasing the volatility of the foreign exchange, and that's the idea. We're trying to decrease the volatility of the foreign exchange. You see, and so that's what we're doing when when we're attempting to perform hedge accounting. Now we've got two broad types of hedging. Um, the first is what I call timing the market, right? So internal hedging is what I call timing the market. What does that mean? So timing the market is basically when you guess, right? You're trying to guess what's going to happen with the foreign exchange. And those of us that are forex dealers here would be very familiar with the guessing game. Right? So it's you guys are trying to guess what's going to happen with the exchange rate, and then you're trying to uh, act in such a way that either takes advantage or I can't really think of, unless you're short selling, I can't really think of a way where you're going to be wanting to make a loss. But generally, you're trying to take advantage of 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 this change in the interest rate, right? So either selling or buying at a specific time in order to make a profit. So that is what internal hedging is, right? It's basically you timing the market. So, for example, let's place that into some sort of context. Okay, so let's say you've got a creditor and you can see in the future that the exchange rate is going to go up, meaning it's going to cost you more rands to pay that creditor off in the future. What you could do is pay the creditor off today, right, at the lower rate, okay, and then prevent yourself from incurring a loss in the future. Right? So that's internal hedging, and vice versa as well. Obviously, if the rate is high today and you believe that in the future it's going to improve, or it's going to cost you less rands to get a dollar, for example, you might try and extend your credit and ask your creditor, give me an extra 30 days, give me an extra few days. Let me just try and pay you later on so that you can take advantage and limit or reduce your loss. So that's internal hedging. Right? So internal hedging is extremely risky because regardless of what the forex traders will tell you, it is extremely hard to predict whether you use technical or fundamental analysis. It's extremely hard to predict what's going to happen with the exchange rate at any given time. Okay, so internal hedging is basically timing the market, right? Not time in the market, it's timing the market, which is the bad thing, which is difficult to do, right? So that is internal hedging. What we're going to be dealing with in back to 100 is what's called external hedging. So yes, there is accounting for internal hedging, and it is quite complex. And in fact, in accounting, internal hedging is considered a specialist field, right? And specialist, it specializes. The specialization comes out of the finance area of accounting. So it is considered a specialist field. So we're not going to get into it in back to 100. Instead, we're going to be focusing on external hedging. Now, what's external hedging? So you guys would be familiar with the fact that we get engaged with a foreign creditor, for example, right? So the foreign creditor, uh, there's a risk that we might need to pay a lot for the foreign creditor, right? So external hedging will be to go and get some sort of other financial instrument, right? Some sort of other thing, right? Uh, uh, and that other thing is an agreement with, for back to 100, it's going to be an agreement with the bank, right? So it's an agreement, it's a financial instrument in which you agree with the bank to exchange foreign currency at some time in the future at a fixed rate. Okay, so it's basically external hedging is where we put the risk on some sort of external party to try and help us to limit or reduce or limit the foreign exchange risk, right? So that is what external hedging is where we go and engage with a foreign party, some sort of third party, the bank or financial institution or an exchange broker, and we engage with them and we say, listen, we want to come to an agreement about a specific transaction that we want to make with you, and the rate must be fixed, and that is the instrument that we're going to be accounting for today, right? So there's lots of different types of external hedging. So there's options, there's derivatives, there's all sorts of types of external hedging. But we're going to be looking at only FECs. Now, FECs in your textbook, for some reason, they mentioned that it could be forward or foreign exchange contracts. For our purposes, we're going to mainly call it foreign. There might be once or twice where you see it called uh, um, forward, but those words are interchangeable. So I don't think you guys need to be too focused on whether it's foreign or forward, but all you need to know is that we call it an FEC, right? So that's what it's called, a foreign exchange contract or forward exchange contract, FEC. And the idea behind an FEC is that our entity, our company, has gone to the bank and got into an agreement to exchange some sort of foreign currency in the future at a fixed rate. That's all it is. And so the date at the future when we want to exchange the currency is what we normally call the expiry or maturity date, right? So the date at which the FEC comes to an end, right? And so that at that date we will give the bank money, rands, and they will give us dollars. They will give us whatever we agreed to, euros or whatever. So that is the future date. The fixed rate, we said we want to exchange it with the bank or foreign or exchange institution at a specific time in the future. So that's the specific time, the expiry date, and then at a specific rate. So that specific rate we call the forward rate. The forward rate meaning that it's the rate that the bank is going to exchange with us sometime in the future, sometime forward in the future. So it's the forward rate, right? So those are the two terms, those are the terminology that you need to be aware of. The forward rate is the fixed rate at which we're going to exchange Forex in the future, or foreign currency in the future, and the expiry date or maturity date is the date at which the actual transaction happens and the FEC comes to an end, right? The contract, the agreement comes to an end. So that's all it is. So FEC is just an agreement with the bank that says that we're going to exchange foreign currency in the future. Okay, so like we said here, the forward rate is sort of a fixed rate that we agree with the bank, and we're going to exchange this amount in the future. Now, in most cases in South Africa, you're going to find that the forward rate is what we call at a premium, meaning that it's higher than the spot rate, right? And that's because the South African currency, the rand, tends to decrease in value when compared to other currencies. And so therefore it always seems to be at a premium. But in some cases, if you're in a booming economy, an economy that's growing faster than the rest of the world, then you will have what's called a discount rate. But that's not super important, and I don't want you to be too focused on it. All you need to know is that I'm going to give you the forward rate in your tests and exams, and you're going to use that rate to calculate the changes in the foreign exchange, in the FEC, right? So let's have a look. Let's try and picture this, right? So the first thing is we look at unhedged items, right? And now you guys are familiar with unhedged items because we did unhedged items before the test, right? So let's just assume this is a hypothetical scenario. We've got a creditor that we bought inventory from, and the transaction date was 1 May, right? So our creditor now, we on the 1st of May, we got value out of them of every dollar. The value in rands was 15 rand, right, on the 1st of May. However, we're only going to pay our creditor, right? We're only going to pay our creditor on the settlement date, right? And then we're going to have to pay 20 rand for every dollar that we took out of it. So we need to increase it. And so what we tend to do is we will increase it, at year end to the year end rate. And then we'd increase it or revalue it again just before payment to the settlement date rate, right? So that's sort of the idea. Now, what I want from you guys is I want you just to pop in the chat. In this scenario, are we going to be making a loss or gain? Are we going to be making a Forex loss or Forex gain? And the idea and the stuff that you're going to look at is you're going to say, okay, how much did we get? What value did we get? And what value do we owe? Right? So how much did we get out of the creditor and how much do we owe the creditor? And so that's basically what you're looking for. See, one person has said loss. There we go. Some other people are coming through. So the idea is, yes, we're making a Forex loss. And the reason why we can say that is because we're moving from 15 Rand to 20 Rand. So we got value out of the creditor of 15 Rand for every dollar. But when we pay that creditor back, we're going to have to now pay 20 Rand on every dollar. So it's costing us more, right? So what we could do is we could engage in hedge accounting, right? So this is hedged. This is a hedged example. So in hedged accounting, what we could do is we'll still have that creditor, right? So the creditor doesn't change, and the journal entries and the disclosure and whatnot that we do on the creditor is not changing, right? So we're still going to have that loss that's going to be, we're going to have to record in our books, right? So we're still going to move from 15 to 20. However, we're going to have a second monetary item, right? So we're going to have another, we're going to engage in this contract with the bank, and we're going to create another monetary item. And if you have a look at the arrows on the right-hand side, you're going to see we're assuming that we're going to make this loss out of the creditor, right? So we're going to make a loss out of the creditor, which is going to be negative, go down. It's going to be bad fast. And then we're going to engage in this other monetary item that hopefully makes a profit, right? And so what the idea is that the profit can outweigh or offset the loss, and then hopefully our company is returned back to its normal place, basically, right? So there's no loss, no gain, and so we're trying to eliminate the loss. So what we could say is maybe on the 15th of March, we now got into or engaged in a FEC, a contract with the bank. And we said in the contract with the bank, listen, in 6 months' time, right? So that's why I'm saying here, in 6 months' time. In 6 months' time, we want to exchange some rands for dollars with you. And then the bank agreed and we signed the agreement. So we've got an agreement with the bank that says in 6 months' time, so on the 1st of October, we're going to give the bank 17 Rand 50 for each dollar, and they're going to give us a dollar in return. So if you have a look on the 15th of March, it doesn't look like a good deal. It looks like it costs 17 Rand, but we are now paying 17 Rand 50. And so the idea, the question is, why would anyone get into this sort of agreement, right? Because on the 15th of March, it doesn't look like a very good agreement, right? Because we're paying more. But the issue is that in South Africa and many other countries, specifically in the developing world, specifically economies that are struggling, it is illegal for companies and people to buy and hold foreign currency. So the question is, why is that so? And it's because of the balance of payment. So you guys who did economics in first year or doing economics now in second year, you guys would remember that balance of payments is basically saying that if we hold a lot of foreign currency, it actually means that our country basically owes another country currency. And so what that does is it deteriorates or it decreases our currency, and therefore our economy is negatively affected. Um, so what that, and we can't sort of purchase internationally. What that means then is when we want foreign currency in the future, we're unable to buy and hold it, right? So we have to go via what we call an intermediary. The intermediary being the bank, the intermediary being a foreign exchange broker. And so we go there and we actually get an agreement with that intermediary that allows us to borrow foreign currency in the future. So because we're unable to hold large amounts of foreign currency for an extended period of time, we're not able to get this the exchange rate at this rate of 17 rand, because if we hold it for a long time, SARS is going to come after us, right? So that's the reason why we would get into the agreement. And then what's going to happen now is at settlement date, we're going to give the bank 17 rand for every dollar. However, the bank is going to give us $1 in return. And on that date, the dollar is worth the spot rate. Right? So I'll say that again. On settlement date, the dollar is worth the spot rate. Okay. However, based on our agreement, we only giving the bank 17 rand 50, but we're going to get value out of the bank of 20 rand. So now can you see that it's some sort of benefit, it's some sort of profit that we're making. We're giving 17 rand, but we're getting something in return, which is the dollar. We're getting that dollar in return, which is worth 20 rand. So we're getting a Forex profit, right? And so now that Forex profit that we're making on this transaction is going to try and offset the loss that we're making on the creditor, which we spoke about initially, right? So that is the idea. That is what hedge accounting looks like, okay? That's what hedge accounting looks like. Now, just before we start, we're going to do an example just briefly now. But before we start that, we have to do a quiz, right? So get ready on your side, and we're going to do a quick quiz just to recap what we did previously and what we did just before the test. So I'm going to just type out the options, and then we're going to read it together. Okay, cool. So it should be appearing on your side. Right, so let's have a look at what it says. So it says the financial year end for this entity is the 31st of December 2018. The following are the exchange rates. Right, so we've got the exchange rates there, we've got the spot rate and forward rate. And then we read question 1. It says, on the 31st of June 2018, the entity purchased inventories from foreign creditor for $50,000. On the 31st of December 2018, so now at year end, the entity will recognize a what? A blank on the foreign creditor. So is it a foreign exchange gain or foreign exchange loss? Foreign exchange gain or foreign exchange loss? Foreign exchange gain or loss? Right? So what do we look for? What are we looking at? We're looking at the spot rate, right? Look at the spot rate, and then we're saying we purchased the inventory there. So we've got inventory worth 10 rand 15, right? But when we pay the creditor, or when we revalue the creditor at year end, we're going to have to revalue the creditor to 10 Rand 20. We just extend that arrow. 10 Rand 20. Right. So have we made a benefit, or is it good for us or is it bad for us? Is it a gain or is it a loss? Let's have a look at what people have said. Okay, so if we have a look there, we can see that the majority of people have said 5, right? Unfortunately, there are some that haven't answered, and they might be the swing votes, but the correct answer is loss. It's going to be a foreign exchange loss because it cost us, or we got value of 10 Rand 15, but when we pay, we must pay 10 Rand 20. So because we're paying more than we got, it means we have made a loss. Okay, so it means we have made a loss. Right, so let's have a look at the next question. So the next question says, on the 30th of June 2018, the entity sold inventories. So now we sold inventories. So now we're dealing with a debtor, to a foreign debtor at $20,000, right? $20,000 on the 31st of December 2018, the entity will recognize a what on the foreign debtor. So a blank on the foreign debtor. What are we going to measure on the foreign debtor? What are we going to measure on the foreign debtor? Is it going to be a gain or a loss on the foreign debtor? Let's have a look at what people are answering. Right, there's still some that we are waiting for. If you haven't answered, please go ahead and answer. Okay, so if we have a look, majority of people are saying foreign exchange gain. That's correct. So it swaps around, right? And it becomes the opposite because we are dealing with a debtor, right? Because we're dealing with a debtor. Now, this is the important bit, right? So this is the important one. Let's pay attention, right? So this one says, on the 30th of June 2018, the entity took out a 7-month forward exchange contract to hedge a payment for $100,000 that has to be made to a foreign creditor on the 31st of January 2019, right? On December 2018, the entity will recognize a what on the FEC, right? So now let's think about this. So when we're dealing with the FEC, we're wanting to use the forward rate and not the spot rate. And here on June, 30th of June, we took out the FEC. It's a 7-month FEC. We took it out on the 30th of June, and then a similar FEC for the same amount at year end would have cost us that. So have we made a gain or a loss on the FEC? Have we made a gain or a loss, right? So let's rationalize it. Let's think about it. So we entered into this contract for 10 Rand 18, right? So we entered into the contract, and as part of the contract, we're going to have to pay 10 Rand 18, right? So that's what we entered into it, and we're going to have to pay 10 Rand 18. However, at year end, if we were to have entered into the contract at year end, we would then be paying 10 Rand 22, right? So we actually got it for what? We got it for cheaper because we entered into the contract so early, right? We got it for cheaper because we entered into the contract early. Therefore, at year end, it would have cost us more to get into the contract. We got into the contract at 10 Rand 18, right? But at year end, if we decided to get into the contract, we would have had to pay 10 Rand 22, right? So it would have cost us more if we got into the contract at year end. Let's have a look at what people have said. As you can see there, majority of people said gain, and that is correct. It is a gain because we've got a benefit. We entered into the contract early, and therefore that means that we have gained on this specific transaction. We bought something for 10 Rand 18 and we held on to it, and now it's worth 10 Rand 22. Right? So that's what it means. We've gotten a benefit, we've gotten a gain. Okay. So let's go back to the lecture now. So we've done that, and that was just to warm us up and get us ready for the rest of Forex. So if we have a look at example 4, let's see if it makes sense to us now. So let's try and put what we've learned into practice, right? So it says on 1 January 2021, the entity purchased inventories from a foreign creditor amounting to $10,000. The foreign creditor must be paid on the 31st of March 2021. On January 2021, the entity takes out a 3-month forward exchange contract for the value of $10,000 at the forward exchange rate of 6.5 or 6 Rand 50. All right. So firstly, does a FEC need to always be taken out on the transaction date? No, right? It doesn't, right? So it can happen at any time. It can be before or after the transaction date. The key is that there must be a link between the two of them. They must be designated to operate as one item, right? And we're going to get into that a little bit later when we start talking about the designation of hedges. So we entered into the contract on the 1st of January, and the contract said we must pay the bank 6.50 per dollar, right? And then it says the FEC hedge was taken out to hedge against a payment that has to be made to the foreign creditor on the 31st of March 2021. So it's just saying that these two items, right? When I say these two items, I mean the FEC, right? The FEC is related to the foreign creditor. That is what this statement is saying. Right? So it's saying the FEC is taken out to hedge the payment that has to be made to the foreign creditor. So it's saying we must treat them as one, is what that sentence is saying. We must treat them as one accounting element when we are recording. Okay, so let's have a look at what the rates are doing. So we started off on transaction date, right? 1 Jan. We started off at 649, right? And 649, and then what we found is that it extended and it moved along, and we need to now pay 653. But we got into a FEC that said we can benefit by paying 6 Rand 50, right? So we would have made a loss on the creditor because the creditor got bigger. Remember, when the creditor gets bigger, that's a bad thing, and therefore we make a loss. And then we would have made a gain on the FEC because we're going to be paying at settlement date, we're going to be paying 6 Rand 50, but we're going to be getting value of 6 Rand 53, right? Everybody understand that rationale? If you do, give me a thumbs up in the chat. We're going to be paying 6 Rand 50 to the bank, right? But we're going to be getting something that's worth 6 Rand 53, right? So it's 3 cents more than what we paid. Okay, so as a result, we're getting a gain. Okay, so let's have a look at what that means. Okay, so we've got the foreign creditor. We recognize the foreign creditor at transaction date, and that means that we have a total. We're owing it on transaction date. We're owing the creditor a total of 64,900, right? But however, at settlement date, the exchange rate has gotten worse, at least, has weakened in terms of the South African rand. So we've gone from 6 rand 90, 6 rand 49 at least, to 6 rand 53, right? And now we owe the creditor 65,300. So we owe the creditor more than what we got from the creditor. So we've made a loss, right? We've made a loss on this creditor. How much loss have we made? We've made a loss of 400 rand, which is the difference between 64,900 and 65,300. And that's how much we made. We made a loss of 400 rand on this transaction. Now, let's have a look at the FEC. So we've looked at the creditor. Let's have a look at the FEC. We got into an FEC, right? At inception date, it said that we must pay 6 rand 50, right? So that's how much we're going to be paying. Okay, 6 rand 50. So at expiry date, on the 31st of March, we pay the bank 65,000, which is 6 rand 50 times 10,000 US dollars. So we pay the bank that money, but when we get the 10,000 US dollars in the market, the fair value of these 10,000 US dollars, the fair value is actually 65,300. So it's actually more at 65,300. We paid 65, we got 65,300. So we've made a gain on the FEC. We've made a profit on the FEC of 300 rand. Now, because the FEC is linked to the foreign creditor, we can actually disclose these two amounts as a whole, as a net of the two, we offset the two amounts. We can only do this in hedge accounting because these two amounts are linked, right? And we're gonna talk a little bit about that linking effect in the next few slides. Okay, so we can only do this because they're linked. So if you have a look here, we've made a loss on the creditor, 400 rand, right? We made a loss on the creditor of 400 rand, but we've made a gain on the FEC of 300 rand. That means that on our financial statements, we now are sitting with a loss of only 100 rand. Right? Can you see how the FEC has protected us against the loss that could have arisen from the creditor? It shielded us. So we've hedged against the risk. That's the accounting word. We say we've hedged against the risk, right? And so what you're going to find a lot of the times in your questions is they're going to ask you for the net foreign exchange gain or loss, right? We ask you for the net foreign exchange gain or loss, and that net foreign exchange gain or loss is going to be 100 rand, right? If we did not have the FEC, we would have had to pay 400 rand. So can you see it saved our bacon? Sorry for those of you that are not eating bacon, but it saved us. Is what I'm trying to say. It saved us 300 rand. Someone asked in the chat, can you make a loss on an FEC? Definitely. So an FEC is trying to decrease volatility. It's not only providing a profit for us. So it wants us to have certainty. That's the idea of an FEC. It's looking for certainty in the business. We don't want risk, so we don't want volatility. We don't want profit one day and loss the next day. We want constant, even, smooth, accounting. And so that's what the FEC is doing. So yes, you can make a loss on the FEC, and when you make a loss on the FEC, you should be making a gain on the creditor, right? You should be making a gain on the creditor to try and net off or equal out the two. Right? So that's the idea. So we haven't passed any journal entries yet. I'm going to show you what the journal entries look like just now. But that is the idea of an FEC. That's the idea of hedge accounting, right? So it's to try and protect us from the loss. We still need to record the loss, but we're also going to record the gain, and then the net effect is that we are protected, right? So let's just talk a little bit about the theory. Now, I'm going to, in this section, we're going to be talking a lot about, theoretical concepts. Uh, you shouldn't expect these concepts to come out as a standalone question in your test or exam. However, they are important to know and to understand if you want to be successful at passing the journal entries, doing the disclosure, and calculating items, right? So the first thing is hedge accounting. What is hedge accounting? Hedge accounting is the accounting that we do where we link the two. If you remember here in this, no, one back. So if you remember here, I said the two are linked. The creditor is linked to the FEC. Hedge accounting is that act of linking two things, two financial instruments on your financial statements. You link them together and then they act and they are presented as one item. So when you're actually presenting your what you call it, income statement, the user of the financial statement is only going to see 100 rand. They're not going to see the 400 or the 300. They're just going to see the net effect, because that's what hedge accounting is about. It's about netting off these two amounts, right? It's about showing only the difference, showing only the net effect. And so hedge accounting is a voluntary type of accounting. So when I say it's a voluntary type of accounting, what I'm trying to say is it is not like IAS 2, right? So it's not like inventory where you have to present in a specific way. There's no you can't say, oh, I've got inventory, but I don't feel like IFRS 2. I don't feel like IAS 2. I don't feel like it. It's not my thing, right? You have to present it. Whereas in IFRS 9, hedge accounting is voluntary. You can account for them as one item, or you can account for them as separate items and have them separately disclosed on the income statement. It's your choice, right? The only thing is, if you decide to implement hedge accounting, you have to let the users of the financial statements know in the accounting policy, right? So it has to be in your accounting policy, and they have specific criteria in IFRS 9 that you must meet. The hedging, the FEC as well as the creditor must meet specific criteria in order to qualify for hedge accounting. Now, I don't want you to think that you're going to be able to, or you're going to be required to do that analysis of whether something meets the criteria or not. That's outside the scope of Back 200. However, I have included the criteria in your class notes for your information that you can read through, and you can have a look and just to understand what I'm talking about, right? So there are specific criteria that have to be met in order for you to do the hedge accounting, and you just need to disclose it on the accounting policies. Okay. Now let's talk a little bit about the terminology, right? So we've got what's called the hedged item, the hedged item. Now the hedged item is what we've already been accounting for, right? So it's the debtor, it's the creditor, it's the loan, right? So those are the hedged items. Those are the items that create the risk, right? The risk comes out of them because of the nature of the fact that they are foreign exchange transactions, because they're dominated in a foreign currency. So the risk, the foreign exchange risk, emanates or comes out of these items, right? So that is what the hedged item is. Now, when in hedge accounting, you must specifically designate. Designate means to allocate or to label, right? You must label the hedged item as a hedged item, because the user of the financial statements must know that this is a hedged item, right? So in your notes of your financial statement, you will say something along the lines of, this creditor, this foreign creditor, and you put the name of the foreign creditor, is going to be subject to hedge accounting, or is a hedged item. so that they understand that this creditor is going to be linked to something else, right? So that's one of the things. The next thing is the FEC, right? So first we spoke about the creditor, the debtor, the loan. The next item that we're going to be dealing with is the FEC. So the FEC is called the hedging instrument, right? The hedging instrument. The hedging instrument is the thing that we're going to use to try and protect us against this foreign exchange risk, right? So that's what the hedging instrument is, and all it does is that it attempts to offset or to limit, right? It's attempting to limit the amount of risk and volatility that the company faces as a result of this foreign transaction. So that's the idea behind the hedging instrument. It's just to limit or to protect us against this specific item. Right. So the next thing I just want to talk to you about is that there's different types of hedging. So we are only going to be dealing with fair value hedging. There is something called cash flow hedging, and basically cash flow hedging is looking at the differences in the cash flow, right? So how much cash is changing, how much cash is going to leave the company or come into the company. Whereas fair value hedging is where we look at the fair value of the hedged item and the fair value of the hedging instrument. So we just look at the fair value of these two items, right? We in Back 200 are only going to be dealing with fair value hedges. We're not going to be dealing with cash flow hedges. We're only dealing with fair value hedges, right? And when we're talking about hedging items, I'm always going to tell you that this is a item that is fully meets the criteria fully, and that we can apply hedge accounting, right? So you guys don't need to do that determination. I'm doing it for you, right? So it will be in your questions like that. So that's what I'm saying here. We're only going to be doing fair value hedging. We're not doing cash flow hedges. And then, so I just wanted to give you an idea of what you need to do, right? What do you need to do when you want to start to do hedge accounting? What stuff do you need to look out for? The first thing I want you to do is try and identify the FEC, right? So you're looking to identify which is the FEC, where is the FEC, when did it start, when does it expire, what is the hedging instrument, right? The next thing is you want to try and find out what is the hedged item. So where's the debtor, where's the creditor, where's the loan, right? So that's the hedged item. We then want to make sure that the hedging criteria has been met. Now, like I said, I'm going to do that step for you. So you're going to find a statement in all of your questions that says the hedging criteria has been met, which means you don't need to discuss it, you don't need to talk about it, you don't need to worry about it, right? So the hedging criteria has been met, right? And so if we just briefly look at the accounting, the hedged item will be accounted for like we already did in the week before the exam. We're just going to be applying the same rules. And then the hedged instrument, we're going to be applying IFRS 9 rules. However, they are exactly the same, very similar to the accounting that we're going to do for the hedged item. It's sitting in a different standard because under certain circumstances, it can be very tricky. However, for Back to 100, we've eliminated all of those tricky circumstances, right? And so you guys are just going to be doing plain, very easy hedge accounting. And so there's nothing for you to worry about. All you just need to know is that it sits in a different standard. It's taken care of by a different standard. However, the treatment will look very similar, right? And I'm gonna take you through and I'm gonna explain the treatment just now. Okay, so guys, we're gonna take a break there, and then when we return, I'm gonna start to talk to you a little bit about more about hedge accounting. So let's take a 5-minute break, and I'll see you back at 14 1429. We'll see you back at 1429. Okay, you guys can start returning. We're going to start just now. No one had any questions during the break. If you do, please don't be afraid to ask. Okay. So we were talking about hedge accounting, right? We're talking about the differences. Now, what I'm going to do in this next section is I'm going to just take you through very briefly, right? Very briefly, we're just going to talk a little bit about the differences between the accounting for the hedged item, so the creditor, the debtor, whatever, or the loan, and then the hedging instrument, right? And what are the differences between IFRS 9 and IAS 21. Now, I said they're very similar, and you're going to see what I'm talking about. They're very similar. There's just one or two differences. So the first thing is on how does the hedged item start? When does it start? It starts on transaction date, right? So it starts on transaction date. And at transaction date, we want to try and measure both the monetary and the non-monetary item, right? So we're measuring the monetary and the non-monetary item on transaction date. We're doing so at spot rate, so at the value on that specific day is when we're going to measure. So how we're going to measure it. So we want to do it on spot rate to give us an accurate value of that specific item on that date, right? So now that is the start, right? That's the start of the hedged item. Let's talk about the hedging instrument, right? So the initial start of the hedging instrument, we're looking for the changes. Remember, hedging accounting, we're doing fair value hedging. We're looking for the changes in the fair value of the hedging instrument, right? The changes of the fair value of the hedging instrument, right? So when we entered into the contract, so we went to the bank, we got a contract, and let's say the rate, the bank said, okay, it's 6 Rand 50, the rate that you're going to get. The fair value on that day will be equal to what? It will be equal to the 6 Rand 50, right? Because that is the rate that you would get in a arm's length transaction. Okay, so the fair value is equal to the cost on this date. On the initial date, the first date, the fair value is equal to the cost, right? Therefore, there's nothing for us to account for, right? Remember, we're not paying the bank at this date, right? We're only going to pay the bank on expiry. This date, we're just trying to record, we're just trying to account for the agreement that we have with the bank. And the agreement, the fair value of the agreement that we have with the bank today is equal to the forward rate that we got today. So therefore, there's no difference between the cost of this agreement and the fair value of the agreement. So there's no journal entry, right? There's no journal entry on the first day or the inception date, the starting date of the FEC. There's no journal entry that we pass on that date. And that is because the cost equals the fair value. So there's no difference. There's no fair value difference that we need to account for. And therefore, that is just that, right? Okay. Everybody understand that? If you understand that, please just give me a thumbs up in the chat so that I know that you've got that. That's a critical concept, right? So the fair value on the first day is equal to the cost, and therefore we're not going to pass any journal entries on that date. Okay. Now, let's just talk about the monetary item. So this is on the left side of the slides. You guys are very familiar with what's on the left side because we've done it before, right? So on the left side of the slide, you're going to see that we now remeasure only the monetary item. We don't remeasure the non-monetary item. It's only the monetary item. So if we bought inventory, we won't remeasure the inventory. We'll only remeasure the creditor, right? At year end. So at year end, we'll remeasure the monetary item at the spot rate at year end. Any gain or loss that we make will go to profit and loss. Statement of profit and loss and other comprehensive income. So because we're doing a fair value hedge, we're not doing a cash flow hedge. So as a result, that is the journal entry that we pass at year end for the monetary item under the hedged item. right? Under the hedging instrument, right, we're going to look for a contract, a forward exchange contract, an FEC contract, right, for the same amount as the one that we have, right, and that expires on the same date as the one that we have. Okay, so let me say that again. We're going to look for a forward exchange contract that has the same amount as the one that we've bought and has the same expiry date as the one that we've bought. So let's say we bought it in June, right? And our year end is in December and it's valid for 12 months, right? So if we bought it in June, when we bought it, it was a 12-month contract. But now 6 months have passed and now we're in December. So we're not going to be looking for a 12-month contract anymore. We're going to be looking for a 6-month contract. Because remember, it must have the same expiry date. So because we've progressed in time, right, we now need to start looking for a 6-month contract. So you're going to see that the months are going to decrease on the forward exchange rates, right? So we want to look for a 6-month, we want to look for a contract with the same amount and the same expiry date. And then that forward rate that we have on that contract with the same amount and the same expiry date, we must compare it to the contract that we took out with the bank. Right? So we're comparing forward rate to forward rate. We're looking at the forward rate of our contract and the forward rate of a similar contract for the same amount and the same expiry date. So we're comparing it to what's happening in the market. We're looking to find the fair value of the contract, right? I'll say that again. At year end, we're looking to find the fair value of the FEC, and we do that by looking at our rate that we've got and comparing it to a similar contract for the same amount and with the same expiry date. Okay, and that gives us an idea of how much this contract is worth in the market. Okay, so that's what we need to compare, the difference between the two forward rates. Okay, and then we're going to make a profit or loss on that specific item. We're also going to raise an FEC asset or liability, right? And the profit and loss that we make, so the Forex gain or Forex loss that we make, will also be taken to a statement of profit and loss and other comprehensive income, right? Because remember, it's going to be netted off against the hedging item, or sorry, the hedged item, right? We're going to net off the Forex gain or loss from the hedging instrument against the hedging item. Okay. And then that's going to go to profit and loss. Okay. So remember, at year end, we moved from forward rate to forward rate, right? Just keep that in mind. And we're going to discuss it just now. So let's say we moved on to settlement date, or the date that the thing comes to the end, right? So on settlement date, what we would do is we'd remeasure the monetary item and state it at spot rate on settlement date, right? So we'd have it at spot rate on settlement date, and any gain or loss will be taken to profit and loss. And then we'd actually need to settle the creditor. So we actually need to pass that journal entry where we pay the creditor. Can you remember I said we always forget to pass that last journal entry where we pay the creditor? So this is what I'm talking about. We actually pay the creditor. Okay? And that's what we do at settlement date. The FEC, it's not called settlement date, it's called expiry date, or it's called maturity date, the date that the FEC comes to an end, right? There, we're going to compare the forward rate, right? And sometimes it might not be the forward rate that we originally got, it might be the forward rate that we remeasured it to, right? So anyway, we're going to compare the forward rate to, we're going to assume, and we're going to say we paid, let's say, 6 Rand 50 to get this dollar. How much is it worth today? The forward exchange contract has come to an end. So we need to find out what is it worth today. And how do we find how much foreign exchange is worth today? We look at the spot rate. So on the expiry date, we don't compare forward rate to forward rate. we compare forward rate to spot rate, because the value of the foreign currency, the value of the dollars that we got, that we received from the bank, is at spot rate. We paid the forward rate, but we got the value back in the form of the spot rate. Does everybody understand that? The value that we got is that we paid the spot rate and we got back we paid the forward rate and we got value back in the form of the spot rate. So we need to look at the difference between forward and spot on expiry date. And again, we're going to make a profit or loss, and we'll take that to the P&L account, or the statement of profit and loss. And then we need to now make the payment to the bank. Remember, I said we're only going to pay the bank on expiry date, right? And now this is the expiry date. So we're going to have to pay the bank, and we're going to pay the bank on the forward rate, right? The rate that was agreed. We're going to pay the bank the money on the forward rate, and then we're going to get foreign currency, which we're going to use to pay the creditor, right? We're going to get foreign currency, which we're going to use to pay the creditor. Do you understand? And then we must eliminate any asset or any sort of thing that we've created in relation to this FEC, right? So let's pass some journal entries, and let's discuss it as we pass it, right? So let's try and put that into practice. Okay, so this is example 5. Right. So example 5 and 12.14 are very similar. Example 4 and 12.14 are very similar, but we're going to talk about it now. So anyway, so we've got, it says prepare the journal entries in respect of the transactions above, right? And then it tells us that the company is a South African company with the Rand as its presentation and functional currency. And then, so I'm going to start reading from here. It says on December, let me just highlight it. On 1 December 2020, the company ordered inventories to the value of $100,000 from a foreign supplier, XYZ Limited. The inventories were also shipped free on board on that date. Now remember, when we're dealing with transaction date, remember I told you that in your questions there's going to be a lot of different things. You know, they placed the order, they signed, they applied for the loan, they did all of these things. We worried about when was the loan granted, or when was it obtained, and when was the goods shipped. Those are the words we're looking for. So here it tells us it was shipped on 1st of December. Now, the reason why this question is not complicated in terms of that side of things is because obviously that's not the focus of this question. I'm just trying to teach you about FEC. So I'm only focusing on the FEC part. All right. So anyway, the transaction date is 1 December. Right. Then it says on 1 December again. So again, like I said, we don't always need to take out the FEC on the transaction date. We can take it out on any date, right? So don't get fooled by that in your questions. We can take it out on any date. However, it must meet the criteria of hedge accounting. It must be linked to the hedged instrument, right? And you're going to see how what that's going to look like in your questions just now. So anyway, on the 1st of December 2020, the company took out a 2-month FEC contract for the same amount, since the creditor must be paid on the 31st of January 2021. So the creditor needs to be paid in 2021, 31st of January, and the FEC that they took out is in relation to that specific creditor, right? So here we've got the rates, and what I've done for you is I've highlighted, or I've created green for the spot rates and blue for the FEC, for the forward rates at least. So that's what we're going to use to try and explain so that you guys understand. Now notice what's happened here is they say that they took out a 2-month FEC rate, but then year end is 31st December. So when they're revaluing it, they're not revaluing it back to a 2-month FEC, they're revaluing it back to a 1-month FEC, remember, because it must have the same expiry date, right? So that's what I was trying to tell you, where the expiry date must stay the same. So the amount of months outstanding will decrease, right? Anyway, so this is what I was telling you about when I was saying that when we look at our questions, we're going to see that the examiner is going to do all the hard work for us, right? So it says firstly that the entity has chosen to do fair value hedging. You're going to see that a lot in your questions. Then it says that the entity has designated the FEC to be a hedging instrument, right? And the foreign creditor, right, is going to be the hedged item, right? So now they're basically telling you that all of the work around the definitions and such have already been done, right? And so if we have a look at the continuation of the question, it says that the company will implement hedge accounting, right? And that the entity has met, or this specific transaction has met the hedging criteria. It also says that they apply fair value hedging only, right? So that's something also that we see. Then it tells us that the year end is 31 December, and the company use control accounts, and we must ignore tax. So these sorts of statements that we seen here about hedge accounting, and that the thing is designated as a hedging item, and that they're using fair value hedging. Those are the types of statements you're going to see in every single one of your questions, right? So get used to it. You're going to see that in all your questions. Okay, so now let's have a look at, let's put it on timeline. So 1 December is our transaction date, right? And we transact and we get value out of the, let me change my color. We get value out of the creditor for an amount of 7 Rand, right? So we get 7 Rand out of the creditor, and then we enter into the FEC. And on that date, the FEC, right? So let's go back. The FEC is worth 7 Rand 3 cents, right? So it's worth 7 Rand 3 cents on the transaction or on the initiation date. But remember, the fair value of the FEC on that date is equal to 7 Rand 3 cents. So we are entering into an FEC that's going to cost us 7 Rand 3 cents, and the fair value is 7 Rand 3 cents. So we're not passing any journal entries on that date. And then we move on to year end, and now you guys are going to get ready in the chat. Have we made a gain or a loss on the creditor? Have we made a gain or a loss on the creditor here? Right? And think about it, because we got into the transaction when it was 7 Rand. Now the transaction is worth 7 Rand 10 cents. So are we owing more or less to the creditor? Right? That's it. So people are saying we've made a loss. That's correct. We are owing the creditor more, and therefore we've made a loss. Right? So now let's have a look at the FEC. What's happening with the FEC? We got into the contract, and it's going to cost us 3 Rand, 7 Rand 3 cents. It's going to cost us 7 Rand 3 cents. That's the contract we got into. But now the contract is worth 7 Rand 12 cents. So have we made a loss or a gain? Have we made a loss or gain on the FEC? We got into the contract, it's going to cost us 7 Rand 3 cents. But now the fair value of the contract is 7 Rand 12 cents. So we have in fact made a gain, right? We have made a gain because it now the fair value is now higher than the cost. So we've got a gain here. It's costing us 7 Rand 3 cents. The fair value is 7 Rand 12 cents. We've made a gain in this situation. All right. And then now at expiry date, we're going to move from, let's first talk about the hedged item or the creditor. We're going to move from year end to settlement date, right? And there we can see again, we're going to make a loss because it's getting bigger, right? But with the FEC, we're going to move from the forward rate that we last measured it at, right, to the spot rate, because that's the amount that we're going to get out of the bank. So we're going to pay the bank. We're actually going to pay the bank 7 Rand 3 cents, and we're going to get 7 Rand 16 cents. But we've already remeasured it to 7 Rand 12, so we only need to account for the difference between 7 Rand 12 to 7 Rand 16, right? So that's basically the idea. Now let's have a look at the first journal entry. So we first want to pass the journal entries at transaction date, right? And at the date that the FEC is taken out. So firstly, we use notice it's in green, so we're using the spot rate here, right? And we're saying 100,000 US dollars at the spot rate of 7 Rand. That means that we've got an inventory out of the creditor of 700,000 Rand. Right? So everyone gets that. Everyone's got that. That's an easy one, right? And we credit the creditor because we want to increase the creditor. We debit inventories because we've got more inventories, and the amount is 700,000 Rand. Notice here for the FEC, we do not pass any journal entries. We're not passing any journal entries for the FEC because the fair value is equal to the cost on this date, right? Now, let's go back to our timeline. So now we are here on 1 December. We want to move, so we there on 1 December. We want to now move along the timeline to year end. Right? So the first journal entry we're going to pass is going to be for the creditor, and it's going to be a loss because we're moving from 7 Rand to 7 Rand 10. We're also going to pass a journal entry for the FEC, and it's going to be a gain because we're moving from 7 Rand 3 to 7 Rand 12. Let's have a look at what that looks like. Right. So again, the creditor is getting bigger, so we credit the creditor. That's it. Yeah. We're gonna recognize a loss because we're now owing the creditor more. Right. That's it. We'll make a loss. And notice we're using the spot rates here. We're saying it's moving from 7 Rand, it's going to 10 Rand, 7 Rand 10 cents, and therefore we've made a loss of 10,000 Rand. Now remember, you're only able to use this type of calculation when we are doing direct rates only, right? Direct rates only. Someone's asked, can I say creditors control instead of foreign creditor? Yes, you can. Yes, you can say creditors control. But I would still say that you need to put in brackets XYZ limited, right? So you can say creditors control because in the question it says that they do use control accounts. So yes, you can do that, but make sure that you say XYZ creditor or XYZ limited. Okay, so again, this calculation we can only use, right? We can only use this calculation if we have direct rates, right? We can only use it if we have direct rates. Remember, if we said if we've got indirect rates, we must not use this calculation, right? We must multiply it out. So it will be 100,000 times 7 minus 100,000 times 7.10. Or in fact, if we're using indirect rates, we need to divide, right? So we wouldn't times it, we'd divide it. Anyway, but I just wanted to highlight that again, that just make sure that you can only use this calculation if you have direct rates, if you're using direct rates. Okay, so that's the loss on the creditor. So now we're trying to move with the FEC from 7 Rand 3 cents to 7 Rand 12 cents. Let's have a look at that. So here, notice we're using the FEC rates, right? It's in blue, so it's the FEC rates. We're not using the spot rates. And we're going with 100,000 from 7 Rand 3 cents to 7 Rand 12. We're making a profit of 9,000 Rand, right? So I'll make a profit of 9,000 Rand. And this little animal here is the first time you've seen this. It's called an FEC asset or liability. Now, I deliberately put asset or liability there because I want you to write asset or liability going forward, right? And the reason why I want you to do that is so that you don't need to keep a track of whether it is a positive or negative, right? Because it will sometimes, in some questions, it will swap over from an asset and become a liability, right? So just put asset or liability there, and then if there's a disclosure portion, you're then going to need to calculate the final rate and decide finally, is it asset or liability, right? So for now, when you're doing your journal entries, just put asset slash liability, FEC asset slash liability. And what that is saying is that we've entered into the contract and now we've got some sort of benefit out of the contract. That's all it means. It means we entered in the contract and we got some sort of benefit. That's what we're trying to say there. Okay, so that's what we're saying. So that is the transaction at year end. So let's have a look at what it looks like now at settlement date and expiry date. So again, we're going to move with the creditor to a loss position, right? And we're going to move from 710 to 716 with the creditor. And then we're going to move from 712 to 716. Now, why are we going back to the spot rate here, right? Why are we using the spot rate here? Oops, that's too far ahead. And the reason why we're using the spot rate is because on that day, the fair value of the money that we receive is equal to the spot rate, right? So if you notice this transaction here, we're going from using forward rate to now using spot rate, right? So we're using forward on one and spot on the other, which means that we are trying to show that the fair value has now changed and the fair value is now equal to spot, okay? So that's what's going on there. So this top journal entry, I'm not going to focus on too much. You guys are aware of what's happening here. We're registering the loss. The creditor is getting bigger. The loss is being debited, and the amount is for 6,000, right? And then here, what's happening in this section is we are now saying that the fair value is equal to spot. Therefore, we have a 4,000 Rand gain, a 4,000 Rand profit, right? And this is now an FEC asset. And the reason why we can say confidently that it's an asset is because it's now being terminated. Its expiry date. There's no more other transactions that will pass for this specific FEC. Okay. Okay. Now, remember, let's go back to our little spiel here. Remember, this last journal entry is the journal entry that we all forget to pass, which is the payment of the creditor, as well as the payment of the bank. So let's have a look at what that looks like. So here we are paying the bank, and notice we're paying the bank at the original rate that was in the agreement, the original forward rate that was in the agreement, right? So that's how much we're paying the bank. We're paying the bank 703,000, right? Then we eliminating or de-recognizing any FEC asset or liability. And how do we come up with this amount? Well, we say we first had a profit of 9,000. We then had a profit of 4,000, which means that we should be having a total of 13,000. So we must remove or eliminate that 13,000. And then the foreign creditor is calculated at 100,000 times the spot rate that he needs to be settled at, right? And that is 716,000 Rand. Okay, and that's the payment of the creditor and the elimination and de-recognition of the FEC. Okay, cool. So let's quickly talk about disclosure. So a lot of the disclosure that we did, we'd find in last week's lectures or the week before the test. And basically, it's going to be all that same disclosure as unhedged items, right? Especially for the loan, for the creditor, for the debtor, that sort of stuff. And then we're only now going to focus on the FEC. So for the FEC, we're going to either record it under under current assets if it's an asset, or under current liabilities if it is a liability, right? That's the only disclosure, additional disclosure that we are going to have, okay? It's the only additional disclosure that we are going to have. Okay, so now I'm going to talk to you guys a little bit about 14.1. 14.12. So it's on page 168 of your textbook. So turn to page 168 of your textbook, and let's have a look at 14.12. Right, so this is 14.12 here. I've reproduced it here for you for our convenience. Right, and so it says we must record the transactions in the general journal of Moses up to 31 December 2021. Right, so up to 31 December 2021. Then it says that we must disclose the information in the statement of financial positions and in the notes of the statements of Moses Limited for the year ended. So the year end is actually in June, right? It's not December. This specific company has a year end in June, right? And they're looking for the so if you guys turn to page 168 of your books, you're going to see that the required day is broken up into A and a C. I mean a B and a C. Whereas here I've combined them and I've just put one required up, right? So we're looking for the income statement as well as the notes, right? So they're looking for both of them. All right, so let's have a look at what the question is saying. So I'm going to read quickly for you guys. Okay, so it says on 1 January 2021, Moses Limited entered into a 12-month forward exchange contract with the bank to buy $100,000 on the 31st of December 2021 at a rate of 6 Rand 50. And then obviously there's a creditor, and it says that the creditor has originated from a purchase. So this is just a summary of 100,000 from Halifax. It's a foreign creditor, and we entered into that transaction on the 1st of January 2021. It says assume that Moses Limited took out the FEC to hedge against the foreign creditor, and that is sort of that statement that we always see in all of our questions. Okay, so basically there's a creditor that started on the 1st of January 2021, and there's an FEC that started at the same time. The FEC the original forward rate of the FEC is 6 Rand 50. Okay, so that's basically what it's telling us. Now you're going to see that this is very similar to example 4, which we did a little bit earlier on, right? Okay, so basically this is our timeline. So notice how I've got two timelines here. One, which is the normal timeline, which we are aware of and we've drawn up before many times. And that's for the creditor, right? And then I've got a separate timeline in which I just talk a little bit about the FEC, right? So here, the creditor started off on the 1st of Jan, and we need to remeasure it at the end of the year, right? And then we've got the FEC also that started off on the 1st of Jan, and we need to remeasure it to an FEC that was similar to it at the end of the year. And then at settlement date, we're going to remeasure it at the spot rate because that is the fair value, right? So that's what we're doing there. So let's have a look at what our journal entries are going to look like. On the transaction date, we're going to pass a journal entry to recognize the inventory. So we're going to debit inventory. We're going to credit the creditor because we're trying to increase the creditor, and it's going to be at a rate of 6.49, 6 Rand 49. Okay, so that's what it looks like there. We are recognizing the creditor. We are accounting for or recognizing the inventories, and it's at 6.49. Right? It's at 6.49. In fact, let's just switch quickly back to the slides because I've reproduced all of the stuff for you guys on the slides to make it easy. So let me go back there. Okay. So this is the same journal entry. So we recognize the inventory, and we recognize the creditor 649, and we get that by taking the $100,000 multiplied by 649. Right. Now, my question to you is, what is the value of the FEC on this date? Now, here is our question. We're going to do a poll. What is the value of the FEC on this date? Right? So I want you to type out in the poll, or select in the poll, your answer. What is the value of the FEC? Okay. On the 1st of Jan, the inception date, what is the value of the FEC? Okay, so your options are, firstly, it's measured at spot rate at the inception date or the starting date, measured at spot rate. B, null, the value is 0. And C, it is the difference between the forward rate and the spot rate on inception date, or on the first date. What is your answer? Okay, let's have a look at what people have replied. So you can see the majority of people there, majority of people have said it is null, and that is correct. The answer is 0. So why is the answer 0 again? The answer is 0 because on that date, the cost of the FEC is equal to the fair value of a similar FEC for a similar amount with the same expiry date. The cost is equal to the fair value, therefore there's nothing for us to record. So it's null. Okay, so the answer is no. Okay, so let's now move on. So far we have processed the journal entry there on that date. We've processed the journal entry for the creditor. There is no journal entry for the FEC, so we haven't processed anything. And now we want to move along the timeline to year end. All right, so we want to get to year end. So at year end, you're going to type out for me in the chat, are we going to have a gain or a loss on the creditor? Have a look at the rates. We're going from 6 Rand 49 to 6 Rand 45. 6 Rand 49 to 6 Rand 45. Are we going to have a gain or a loss on the creditor? So someone's asked, can you explain again why? So people are answering correctly and saying we're going to have a gain on the creditor. But so thank you, that's correct. I also just want to address the comment, why is the FEC 0? The FEC is 0 because on the date that we took out the FEC, right? If we were to take out a similar FEC for the same amount, with the same expiry date, we would get the same rate. It would be, the forward rates would be equal. Therefore, the fair value of that FEC is equal to the cost of the FEC. The fair value of the FEC on that date is equal to the amount that we would have gotten for the FEC. Therefore, it's 0. Therefore, there's nothing for us to journalize because the value is equal to the cost. So if we went to the bank and we took out an FEC, right? So let's say we took out an FEC this morning, right? And we got a rate of 6 Rand 50. Then this afternoon, now I'm busy passing the journal entry, and I tell you, right, go to the bank now and ask the bank, what rate can you get? The bank will give me the same rate, 6 Rand 50. So therefore, there's no difference between the rate that we got in the morning and the rate that we got now at 3 o'clock. So therefore, there's no difference in between what it cost us and what the fair value is. There's nothing for me to process. There's no journal entry for me to pass. Okay. I hope that explains. Okay, so now we're going to move with the FEC, and someone asked me earlier on, can we have a loss in the FEC? We're going to move from 6 Rand 50, right, to 6 Rand 40. Okay, so it cost us 6 Rand 50 to get into this contract, or it is going to cost us at expiry date. It's going to cost us 6 Rand 50. But how much would we have paid if we took out the contract now? We would have actually paid 6 Rand 40. It cost us 6 Rand 50, but it would have cost us 6 Rand 40 if we took out the rate now, today. Okay, if we took out the rate now or today, it would cost us 6 Rand 40. So we have made a what on the FEC? We have made a loss on the FEC. That's it. Yes, we made a loss on the FEC. We should have actually waited. We shouldn't have took out the FEC on 1st Jan. We should have waited and took it out on the 30th June, but we didn't know. So we've made a loss, right? And again, can you see how generally, right? Generally, when the creditor is having a gain, the FEC is having a loss. When the creditor is having a loss, the FEC is having a gain. Can you see that's generally what's happening? I'm not saying that's always going to be the case, right? I'm not saying that's always going to be the case, but I'm saying generally that's what's happening here. Okay. Let's have a look at our journal entries. So on 30th June, right, we pass a journal entry to record the gain or profit on the creditor. So we decrease the creditor by debiting the creditor. We increase the amount of income by crediting the foreign exchange gain or foreign exchange profit. Remember, those words are interchangeable and you'll get marks for both of them. And the amounts that we use are both the spot rates, right? So we go from one spot rate, this being the older one, so 6 Rand 49, the older spot rate, to the new spot rate. Remember, we can only use this calculation if we're dealing with direct rates. But one trick for you guys, right? One trick that you can think about and remember is if you put the old rate first and you're dealing with a creditor, right? So if you're dealing with a creditor or a loan, and you put the old rate first and then the new rate, right? So I put the old rate first and then the new rate. And if the product of this calculation is negative, then it's a loss. However, if the product of this calculation is positive, then it's a gain, right? Only when we're dealing with a creditor, because remember, when we're dealing with the debtor or with an asset, it will be the opposite way around, right? The whole thing. Remember, we said that the debtor is the creditor in reverse, so it will be the opposite way around. So only when we're dealing with a creditor, if we put the old rate first and then the new rate, and the product is a minus, that means we made a loss. If we put the old rate first and then the new rate, and the product is a positive, means we made a gain or a profit. So if you put this into your calculator now, you're going to find that you're going to get a positive 4,000, right? You're going to get a positive 4,000. Therefore, we've made a gain, right? Now, remember, when we're dealing with the FEC, we're not dealing with a creditor. We're dealing with a type of, we're hoping that it's going to be a type of asset. So if we did the same thing with the FEC, right, and we put the they've actually put it the incorrect way around, right? Not the way that I was just teaching you. But if you do it in that way, you'd also see that you're going to get a loss amount, and therefore that's why we're recording a loss here. Okay, so that's just a trick for you guys, but you can use it, don't use it, whatever. Just do whatever you're comfortable with. So here again, we're moving from 650, we're moving to 640, right? We're moving from 650 to 640, and because we're dealing with an asset, right? If it is positive it's going to be a loss. And if it is negative, it's going to be a profit. So because it's positive, the product of this calculation is positive, we know that it's a loss. Remember, we're dealing with an asset. We're not dealing with a liability. We're not dealing with a creditor. So as a result, we record the FEC loss here, right? We record the FEC loss. Now, the FEC loss is 10,000 Rand. So if we were to look at this, because remember this is year end, if we were to look at this transaction, right, and remember hedge accounting, we look at the whole transaction as one transaction. What is the product? What is the result of this whole transaction? It is a 6,000 Rand. You guys are going to tell me loss or gain. It's 6,000 Rand loss. That's it. It's a 6,000 Rand loss. Remember, we deal with them, we present them as one item on the income statement, right? So they present them, even though they're separate, right? They're separate, but because of hedge accounting, we're allowed to present them as one item on the income statement. Okay, so just remember that. We're going to come back to that just now. Okay, so let's look at our timeline. So now we're moving towards settlement date and expiry date, right? So we're trying to move from there. As you can see, it's getting bigger. So that means our creditor is getting bigger, which means we are making a loss, right? And now we have last measured this specific FEC. So that's the creditor, right? So leave the creditor out. I'm going to talk about the FEC now. We last measured the FEC at 6.40, but when we complete the FEC, we're going to get dollars that are worth 6.53. So we're going to make a profit on the FEC and a loss on the creditor. Let us see what that looks like. Okay, so here it is here. We're moving from, this is the old rate, remember? Got the old rate first and then the new rate. So if the product is a minus, which it will be, right? In this case, it will be a minus. We know that we have a loss, right? So we've got 100,000, and we say the old rate minus the new rate gives us a loss, and we want to actually debit the loss and credit the creditor, making the creditor bigger, right? Because our creditor is getting bigger now, so we make the creditor bigger. And so that is what we do there. Now here with the what you call it, the FEC, we're moving from 6.40, right? We're moving from 6.40 to 6.53. So we're getting more money than we had paid for, that we had measured it previously. So we need to produce this, and this is going to give us an answer of 13,000, right? And it's a profit of 13,000, right? And we have the FEC asset or liability. Notice how we've written it out here, so that regardless of whether it's an asset or liability, I'm always right. Okay, I'm never going to lose my marks because I'm always writing it in a way that gains me marks. Okay, and now, so now we're at settlement date. Remember what happens at settlement date? We always forget to pass the last journal entry, and the last journal entry is to pay the creditor or to eliminate or to de-recognize the FEC asset. Now, for me, you guys are going to calculate what is the FEC asset at settlement date. So we started off with 10,000 Rand loss, right? And then we had a 13,000 Rand gain. So we have how much sitting in that account? Your answer in the chat box now. I want you to indicate whether it's going to be an asset or liability. I want you to indicate if it's an asset or liability. How much is sitting in that account now? Again, I'll show you. We've debited the asset, or we debited the account Yeah, we debited the account with 13,000 at settlement date, right? So that's what we can see there. We debited the account at 13,000 with at settlement date, but in the past we had credited. See now it's on the credit side. You can see now it's here. We had credited the account with 10,000. So we actually sitting with a debit or with an asset. That's what a debit. That's how you can call it. It's an asset of 3,000 rand, right? So what we now wanting to do, want to pay the creditor. How much are we going to pay the bank in order to get our money, right? So let's go back to the question. We actually going to pay the bank 6 rand 50. That's the amount that we agreed on. 6 rand 50. That's the FEC contract. We're going to pay the bank 6 rand 50. We're going to get $100,000, and then we're going to pay the creditor with that $100,000, right? So this is what the journal entry is going to look like, right? So the journal entry is going to say we pay the bank with the 6 rand 50 amount, right? This is the amount that actually leaves our bank account. Okay, we've got this FEC asset of 3,000 rand, but let's just hold off of the FEC asset because when we pay the creditor, we have to pay the creditor at spot rate on the settlement date. So we're using 6 rand 53 to pay the creditor, and the difference between these two amounts will always be equal to the FEC asset. Difference between the two amounts, between the amount that we pay the creditor, amount that we pay the bank, is always going to be the FEC asset. Okay. Okay, so let's have a look at what it looks like now. Remember, so this last journal entry that we just looked at is in December 2021. We are now looking. Wait, just wait. Yeah. So it's in December 2021, the last journal entry. Let me just go back. All right, so this is in December 2021. We're now going to go back in time, right, to June 2021 for year-end date, right? So notice how the examiner has asked you. The examiners asked you first the December question and then the June question, okay? So don't get confused with that. They've asked you to go back in time. So when you go back in time, you find that we've got the on the income statement, we're going to have the Forex loss, right? And where's that loss from? That loss is from here, from what happened at year end. We've got the 6,000 Rand loss, and this is what it looks like. It's under, let's say, other expenses, 6,000 Rand foreign exchange loss, right? And this is the calculation. This is how we came up with it, right? But you guys know that. And then in the profit before tax note, we'll also indicate, listen, we've got a loss here under other expenses, and it's at an amount of 6,000 Rand, right? If we were to look at the notes, right, the accounting policies, we're going to see that in the accounting policies, they have said here that they engage, right? They engage in some sort of foreign currency transactions, right? So they engage in liabilities and assets that are sometimes foreign currency transactions. Any profits that they make from this foreign currency transactions are credited to income, right? So it goes to the statement of profit and loss and other comprehensive income, right? So that's what they're trying to say there. It's not. It's a fair value hedge, basically. It's not going to go anywhere else, right? So it's not a cash flow hedge. It's not going to the cash flow, right? So that's what they're trying to say there. And then they're also saying that they are performing or they're engaging in hedge accounting, and they're engaging in hedge accounting with the use of forward exchange contracts, what we call FECs, right? So that is what the accounting policy is going to look like. I'm not going to go into detail into it, but you guys are going to learn that off by heart for me. And just in case it comes out in a test or exam, you're going to have it memorized and ready. Okay, guys, so that's the end of today's lecture. Um, we're going to continue with this topic, but when we come back and when we do the next lecture on Thursday, we're not going to do any new theory. We're actually just going to use it as practice. So we're going to do additional example 2, and on Friday we're going to do additional example 3, and we're just going to do practice on this topic just to get ourselves, working with it and comfortable with it. So I want you to use the time now between now and Thursday to go through those 2 examples. And so when you come to a class on Thursday and Friday, you're able to mark those examples with me, right? And tell me where your common problems were and where you didn't get what I'm saying, or maybe you don't understand what I'm saying, or you thought differently. So that's what you're going to do for me between now and then. Okay. Thanks, everyone. Have a good afternoon. And we're going to go straight into consultation now.